Hi, thank you very much for taking this course called How to Start Investing. My big promise to you for this course is that I will show you how to start investing in only 30 days without any prior finance knowledge and with as little as $5,000. Let me share with you a little bit about my story. I was first exposed to investing at the age of 13 when I read the book Rich Dad Poor Dad. By reading that book, I understood how important it is to invest and not just rely on the age-old mantra of go to school, get a good job, and retire with a good sum of savings. I therefore read multiple books, attended many seminars and trainings during my college days. And when I graduated and got my first job, I thought I knew it all, and I went out and bought a stock that tanked by 90%. However, refusing to accept failure, I then spent almost $6,000 on trainings and mentors, and sometimes some of it didn't work for me. However, I continued to read even more books, attended more seminars, sometimes up to 5 times a week, over a period of several years. And then finally, one day, 13 years after reading the book Rich Dad Poor Dad, that fine day, it finally made sense. It all made sense to me, finally. And then I applied that knowledge to make a return of about 50%. My entire account went up 50%. And one of the stocks that I bought, it doubled in just 7 months. And today, I manage my portfolio, which has reached well into the 5 figures. Because of these results, some good opportunities came by. For example, this one right here. This is a picture of me receiving an autographed book from Mary Buffett, who was the ex-daughter-in-law of Warren Buffett. And she learned from Warren Buffett for about 10 years or so as his daughter-in-law. So what will this course do for you? There are a few objectives that I had in mind when I created this course. Firstly, I want to simplify for you what investing is all about. When you start investing, it can be all too confusing with learning this and learning that and all kinds of jargons. But I want to simplify and explain exactly what this investing thing is about. Number two, I want to show you how you can have enough money to invest. When you're first starting out, not having enough money to invest can be a big problem. I faced the same problem, and I will show you how I overcame it. Number three, you will learn the secrets of how money works that not a lot of people know. Once you learn this, you can overcome the fear of investing. A lot of people are fearful of investing because of, say, for example, the 2008 financial crisis. But if you know how money works and why those crashes occur, you will not be afraid anymore. And lastly, I want to show you how you can set and achieve your goals when it comes to investing, in spite of any limitations that you may have. For example, lack of time or not knowing how to read financial statements, etc. All these challenges can be overcome by finding a strategy that fits you and your unique individuality. So let's get started. The first step to investing is how to overcome your fear. Studies show that after the 2008 financial crisis, a lot of people, especially millennials, are afraid to invest. I faced this problem myself. During 2008, I was in college and I saw a lot of people around me getting affected by the crisis. Some of my friends lost their jobs and so on. And to make things worse, as I just shared with you, when I made my first investment, I lost 90% of my money. However, I went out there and learned a lot of things that helped me overcome this fear. And in order to overcome this fear, we need to understand how money works. So let's look at this fictitious island of Moneyland, where there are 3 people, a fisherman, a baker, and a weaver. And the fisherman makes 10 fish, the baker makes 10 loaves of bread, and the weaver makes 5 robes for people to wear. You see, in the old days, people resorted to barter to get what you didn't have. So if the fisherman wanted some bread, he had to offer his fish to the baker and get the bread in return. But sometimes the problem would be that the baker may not want the fish. So we realized that we need to create this thing called money. So what this fictitious island of Moneyland does, in our example, is they create dollars to create paper money, and they put a price to each good. So a fish is $5, a loaf of bread is $3, and one robe is, say, $10, for example. So if you add these numbers up, there's a total of about $130 worth of goods that they are producing. In order to make sure that they don't just create money out of nowhere, each $1 note is redeemable by 1 ounce of silver coin. And this is the monetary system that we had up until about 1970. Now, let's say, for example, they say, okay, we don't want this silver and all that trouble of converting and all that stuff. So let's just create paper money as and when we want. So what they do is they create $3 million worth of $1 bills. And now each of those 3 people could become a millionaire. Yippee! But the problem with that is, what good is all that money when the production of goods is still the same? The purpose of all those paper money is to buy goods with it. Creating more paper money and not creating more goods that money can buy is of no use. The only result that will have is that the prices of goods will rise. So before, let's say if you had $100 in savings, you could have bought a lot of fish and some bread and some robes with it. But now, as you see in the table here, since so much money has been created, the price of fish has gone up from $5 to $500. And therefore, $100 in savings now cannot buy you anything at all. You may have wondered, where does money come from? They say money doesn't grow on trees. It is created out of nothing on computer screens. The problem is you and I can't do that. That would be called counterfeiting. But the banks can create money out of nowhere. And that's why, as we see in this example, the prices of goods keep rising, and that's referred to as inflation. And that's why, if you and I save money in the bank, eventually over time, it will lose its value and it cannot buy as many goods. Now let's look at another scenario. Let's say that Moneyland creates all this money, but instead of just giving it away, let's say they lend it out at 5% interest. So now, each of these people, the fisherman, the baker, and the weaver, they all have $1 million in the bank. Now what that can create is that the fisherman goes out, the fisherman and the baker, for example, they go out and they spend all this money to buy robes from the weaver. So initially, the weaver is doing awesome. He's seeing all this business come in, and his business is flourishing, and things are rosy and things are great. However, just because you have more money doesn't mean you're going to buy more bread and fish to eat, because there's only so much you can eat in a day. Therefore, when the time comes when the fisherman and the baker have to repay the $1 million at the 5% interest, they say, uh-oh, we don't have that money anymore. So now they're forced to sell their homes or sell their belongings in order to come up with the money to pay it back. And now, since they don't have all that money to spend, they cannot buy as much stuff from the weaver anymore. So his business is affected. This is what is referred to as the business cycle, and that is what causes stock market crashes, as we will see shortly in more detail. So we can explain student debt in the same way. Of course, it is a bit more complicated than this, but the simplest way to explain how student debt got so high is as follows. So let's say there's a student, there's a college, and initially, when money could not be created out of thin air, the student was able to earn about $5 an hour, and the college would charge about $1,000 a year in tuition. Now, we went off that gold standard, the convertibility, and we allowed people, or the banks specifically, to create money out of thin air. So now what could happen, and what has happened, or rather what has sort of happened, is that the students continue to earn $5 an hour, say for example, but now the college raises their tuition to $100,000 a year. So how are they going to afford? How are the students going to afford these $100,000? Now what the banker does is they create $100,000 out of thin air and they loan it out to the student as a student loan in order to pay for college. And that's the simplest way to explain how student debt got so high. Of course, it's a little bit more complicated than this, but this is highly simplified in order to make it easy to understand. So you may be wondering, well, which one is it? Is money being created or is debt being created? The answer is both. Money and debt are both created simultaneously. So prices rise, but also debt levels are also constantly rising. And that leads us to the Austrian theory of the business cycle, which says that if you create too much debt, it leads to bad investments. The money goes to people or maybe even companies who can't afford to pay it back. And when they cannot pay it back, the music stops, so to speak, and things come crashing down. Just like in our example, where it was time for the fisherman and the baker to pay the money back, and they couldn't pay it back, well, now they cannot buy as much stuff from the weaver anymore, and therefore the weaver's business is also affected. So, this can help us explain what causes stock market crashes. It's the exact same thing. It's too much debt. When banks lend out too much money and when it can't be paid back, things crash. An example would be in 2001, we had the dot-com crash. And 2008, which we all remember all too well, was the housing crash. Now let's look at a layman example of this Mary's bar to understand exactly how these crashes occur. Here's an article that I once found on the internet that explains this concept pretty well. It says, Mary is the proprietor of a bar in Dublin. She realizes that virtually all of her customers are unemployed alcoholics and as such can no longer afford to patronize her bar. She will go broke. To solve this problem, she comes up with a new marketing plan that allows her customers to drink now but pay later. She keeps track of the drinks consumed on a ledger, thereby granting the customers loans. This is key. Word gets around about Mary's drink now, pay later marketing strategy, and as a result, increasing numbers of customers flood into Mary's bar. Soon, she has the largest sales volume for any bar in Dublin. All is starting to look rosy, just like in our example of the fictitious island of Moneyland. And I'm going to skip through some details to simplify things. A young and dynamic vice president at the local bank recognizes that these customer debts constitute valuable future assets and increases Mary's borrowing limit. To simplify things, what the bank does is they loan Mary a lot of money to keep this business going so that people can continue to buy from her even though they can't afford it. And then, once again, to simplify things, I'm going to skip through a lot of things. And one day, what happens is that a risk manager at the original local bank decides that the time has come to demand payment on the debts incurred by the drinkers at Mary's bar. He so informs Mary. So he goes to Mary and says, please give us our money back, thank you. So Mary then demands payment from her alcoholic patrons. But being unemployed alcoholics, they cannot pay back their drinking debts. And since Mary cannot fulfill her loan obligations, she's forced into bankruptcy. She's now broke. The bar closes and 11 employees lose their jobs. Her wine supplier also claims bankruptcy, closing the doors on a family business that had endured for 3 generations. So this is a good way to understand how, when you have a fiat monetary system, a system in which money can be created out of thin air and can be loaned out just by a few banks and not the rest, how it can create all these boom and bust cycles. What I find really interesting is that a lot of people warned us about this many years ago. For example, Henry Ford said, the goal of these financiers is world control by the creation of inextinguishable debt. Thomas Jefferson, one of our founding fathers, once said, if the American people allow private banks to control the issuance of their currency, they will, first by inflation, or creating money and lending it out, which is what I put in brackets to simplify things. They will first by inflation and then by deflation, which is asking for the money back and seizing people's property if they can't pay back. By doing that, the banks and corporations that will grow up around them will deprive the people of all their property until their children will wake up homeless on the continent their fathers conquered. Another thing I found really interesting was that there was a book called This Time is Different, and what that book proves through several research and data is that these booms and busts, or these market crashes that we are all afraid of, it's been going on for centuries. It's nothing new. So let's look at what that book has to say through the book review on our website. So here's a Wall Street Journal article talking about the book This Time is Different. And it says, boom, bust, repeat. Financial meltdowns typically follow real estate bubbles, which may sound familiar after 2008, rising indebtedness, and gaping deficits. I'm going to fast forward to some of the really good parts. For example, here it says, this lengthy historical study gives what they call a panoramic view of the unending cycle of boom and bust, showing how claims that this time is different are invariably proven wrong. And they've compiled an impressive database which covers 8 centuries of government debt defaults from around the world. So as we can see, debt always has the role to play. And the only reason that so much debt can be created is because money can be created out of thin air. Then the article goes on to say that, but they offer frustratingly little economic theory to accompany their findings. There is nothing here on the role played by loose monetary policy, which in layman terms means creating money out of thin air and just lending it out like crazy. There's nothing here on the role played by loose monetary policy in fueling the speculative manias, although this subject has been addressed by earlier generations of economists, most notably the Austrian school, of which Ludwig von Mises and Hayek are the best known representatives. And of course, the Austrian theory of the business cycle is something that we have previously discussed. So this leads us to the discussion on psychology. As we have seen, all these booms and busts are nothing new. They've been going on for centuries and usually for the same reasons, which is the creation of too much debt. So when the market crashes, what it really means is that the smoke and mirrors game of creating all this debt and then artificially making things look rosy, this game has ended. And so the stock market and the prices are back to the fair value or even lower. The reason why they went so high in the first place is because of all this debt that was created. Now that it has crashed down, it means that the stock market is back at a fair value or at a good price. So which means it's a good time to buy. Unfortunately, what happens because of human psychology is that when the market crashes, people tend to run away and sell off their investments and wait for things to recover. Which is why there's a saying that the stock market is the only market where people run away when things go on sale. As we have seen, the stock market goes up and down. Sometimes it goes up, which is called a boom, and then there's a bust or a crash that happens, such as in 2008. This is sometimes referred to as a cycle. Nothing goes up forever, nothing goes down forever. Other investments, such as real estate or bonds or gold, also go up in cycles. They don't go up forever or don't go down forever. So understanding and embracing the fact that nothing goes up forever, nothing goes down forever, if you understand that and embrace that fact, it is the key to overcoming the fear of investing. This has been going on for centuries, as we just saw. It's nothing new. Learning this helped me overcome my fear of investing, and I hope it does the same for you. The conclusion of what we have studied so far is that A, prices keep rising due to inflation, and hence savings keep losing their value. But on the other hand, the stock market can be volatile. It doesn't go up forever, right? There is always a crash that happens once in a while, as we saw in 2008, in 2001, and even previously in history. And these crashes can scare people away or cause them to lose money. So what's the solution here? If you put your money in the bank, it's definitely going to lose its value. But if you invest at the wrong time and you get caught in a crash, you could lose money. The only solution that I can think of is to get educated and invest with a proven strategy, which is what we're going to learn next, of how to do that. So now that we have looked at some secrets about how money works and what causes the stock market to crash, we can move on to how we can get started investing. The first step to investing is to pay yourself first. Now, this could make or break your finances. Warren Buffett once said, "Don't save what is left after spending. Spend what is left after saving." This was such a huge revelation for me that it completely transformed my portfolio. Before I knew this, I was struggling to save. I didn't know exactly how much I was saving each month, and I was not systematic. But once I learned this, I made it a point to set aside a big portion of my paycheck every month and immediately put it inside my investments. And that really turbocharged my results. And I'm sure it can do the same for you. The reason why this is so important is because of compounding interest. So let's look at how a typical investing journey would look like if you do pay yourself first every month, as opposed to if you don't. So here's a compounding interest calculator. And as they say here, compound interest means that the interest you earn each year is added to your principal so that your balance doesn't merely grow, it grows at an increasing rate. It's one of the most useful concepts in finance. So let's see how that works. Let's say you have $3,000 available to invest. And let's say your average rate of return is 10% because historically the average stock market return has been 10%. So let's assume that you get a 10% return next year. So after 1 year, what you have is you have the 3,000 plus you made a 10% return, and 10% of 3,000 is 300. So now you have 3,300. Now what you do is you don't withdraw that $300 and go spend it. You reinvest $300. So let's say you start with $3,300. Then after 1 year of 10% return, what you would have is you would have 3,630 because this year you made 10% of 3,300, which is $330. Last year you made 10% on 3,000, which is just $300. So now you have 3,630. So let's put that in here. Now 10% of 3,630 is 363. As you can see, in your first year you made $300, then you made 330, and now you're making 363. So your return in absolute dollar terms every year is increasing, and that's because of compounding interest. That can only happen if you reinvest all your returns. So let's say how much you would have after, say, 30 years of investing. Let's say you start off with $3,000 and you get a 10% average per year. Let's see how much you would have after 30 years. You would have about $52,000. Now let's say you make it a point that every month you're going to save $100, and therefore your annual addition, which is $100 a month, is $1,200 a year. So let's say that in addition to this $3,000 that you started with, every year you add another $1,200 to your portfolio over the next 30 years. Let's assume you get the same rate of return, and now is when the magic happens. Instead of $52,000, you have $249,000. It's almost $200,000 more than what you would have had if you had not been saving every month and adding it to your investments. That's how powerful it can be to always pay yourself first and every month channel a portion of your income towards your investments. The best way I found to do that and what has worked for me is that the moment I get my paycheck, I set aside a portion of it for my investments. So there's no temptation to spend it. There's clear visibility that I have this much earmarked for investments, and therefore this month I only have so much money to spend. And I have to buy whatever I want to buy within that budget. Alright, so now we have learned about how money works, why it is important to invest, and why these crashes occur. And we've also seen how important it is to pay yourself first so that you have more money eventually, and also you make sure you always have enough money to invest. So now we can look into strategy. You see, after I've made my first loss of about 90%, I vowed to learn the best and safest investment strategy. I made it a point that no matter what happens, no matter what it takes, I'm going to go out there and learn which is the best and most safest investment strategy that will cause me to never ever lose money and make tons and tons of returns. I spent 5 years looking for it. I learned value investing, dividend investing, options, Forex, technical analysis, PE ratios, discounted cash flow, and so much more. But eventually what I realized is there are tons and tons of different strategies. You need not and you cannot do all of them. You only need one strategy that works for you and do it consistently over time so that you reap the rewards. Now, looking back, I realized that investing is like trying to lose weight. If you had a goal to lose weight, you don't need to run and swim and cycle and go to the gym and learn how to play tennis and learn soccer and learn football and play baseball, etc., etc., etc. Just one sport will suffice, right? You only need to do one of them. What is most important is that you enjoy what you're doing, and therefore you do it consistently so that you actually reap the rewards. It's no point going swimming one day and then not doing anything for the rest of your life. You would much rather be better off doing cycling if that's what you really prefer and enjoy, but do it either every day or 3 times a week, and then you will see results and you probably will lose some weight. So, likewise, in investing, I hear all too often from my friends, they say, I've tried investing before, but I stopped because I don't have the time to analyze financial statements and keep up with the news. Or some of my friends say, I tried investing before and my stock went up for a month, but then afterwards it crashed a week later. Or some of them say, I cannot invest. Investing is not for me because I'm not the investor type. I don't follow the news much, so there's no way I can invest. In order to overcome all these problems, what we need to do is examine our goals and preferences and any limitations we have and create a strategy around it. So, for example, if you are trying to lose weight, but the nearest gym was an hour's drive away, then you might be better off finding a home-based workout and doing it consistently so that you achieve your goal of losing weight. Likewise, in investing, we need to examine what our goals are, what preferences we have, such as some of us may not like to look at charts, or some of us may not like to analyze numbers and look at balance sheets and so on, and any limitations that we have. For example, a friend of mine said that he works 12 hours a week, so he has very little time to actually look into company financial statements and so on to invest. All these limitations can be overcome by finding a suitable strategy. The reality is that all strategies will have great years and some not so great years. There is no one strategy that is going to outperform everybody else every year. Consistency is actually the key. So, in order to create a strategy that's going to work for you, the first question you need to ask yourself is, how much time would you like to or can possibly spend on your investments, say every week or every month or every year? The reality is that some strategies are surprisingly effective, as we will see shortly, and they take as little as 30 minutes a year. Not a day, a year. Second question to ask yourself is, how long would you like to hold on to an investment? Do you prefer to buy and sell frequently or only once in a while? You see, some of us are more long-term investors. For example, if I buy a stock, I'm more than happy to hold it for 2, 3, 4 years as long as the company is doing well. However, some of my friends, as soon as they make some profit, let's say a few $100s or a certain percentage, they would sell it and then try and look for the next opportunity. The third question to ask yourself is, what's your goal? Do you want to have a big sum of money at age 55 or 60 when you retire? Or do you want to create monthly income in the next few years? Certain investments do not give you a monthly income, and certain investments do give you a monthly income. So accordingly, you will be using different strategies. And lastly, do you have any preferences? For example, some common ones are, I don't have the time, or I dislike reading financial statements, or I hate looking at charts, I just don't get them. All these challenges can be overcome by creating a suitable investment strategy. So when I went out, I tried to learn all kinds of things, trading, dividend investing, value investing, CFDs, stocks, REITs, ETFs, options and rebalancing. And then some people said, you should buy and hold it forever. That's the best way to invest. Some of them said, no, that's crazy. You should sell quickly and take profits as soon as you can. However, eventually what I realized is that there is no one size fits all. It all depends on what suits you, and therefore what is it that you're likely to do consistently. Because investing is not a 6-month or a 1-year game, it's a consistent affair. So look at your goals, and then you look at what kind of time horizon you have and how much time you have available to spend on investing. And accordingly, you create a strategy that works best for you. So having understood that, let's look at some typical avatars that I have come across through my interactions with friends and others. For example, some people say, I want a nice big sum of money at retirement at age 55. I don't want to read financial statements and reports. And also, I don't want to spend more than 30 minutes a year managing my investments. Well, I have news for you. You can do this. In fact, there is one strategy that, if used from about 1971 to 2012, would have transformed $10,000 into over $400,000 with only 3 years of negative returns, which means from starting from 1971 to 1972 to 1973 and all the way till 2012, if you look at the yearly performance, there was only 3 years that your portfolio would have been down, and the most that it would have been down is about 4%. Let's look briefly into how this works. In order to understand how such a strategy works, we need to first understand what an index fund is. An index fund is a type of mutual fund with a portfolio constructed to match or track the components of a market index, such as the Standard & Poor's 500 index. So what that means is that it is a fund that invests in several different companies so that it gives you broad market exposure and low expenses and low portfolio turnover. So for example, if you bought an index fund that tracks the S&P 500, you would be buying into 500 of America's top companies. Another thing to understand about index funds, as this article explains, almost no one can beat the market, and they say seek shelter in low-cost index funds. And they say that year after year, decade after decade, evidence has piled up that neither individual nor professional investors can outperform the broad market indexes consistently over long periods of time. So by buying the index fund, you are doing better than a lot of people, and you don't have to go through financial reports or statements or anything like that. And your risk is lesser than if you picked an individual stock, because if you pick an individual stock, the company could potentially go bankrupt. But if you bought an index fund with so many different companies, such as 500 companies in case of the S&P 500, even if one or a few companies go bankrupt, it doesn't make or break your portfolio. So having understood that, let's look at this website called portfoliovisualizer.com, and let's see how you can invest by spending just 30 minutes or so a year. Let's say you start off with $3,000, and let's say you buy an index fund for stocks. An example could be SPY, which is the index fund for the S&P 500. Then you buy another index fund for, say, bonds, for example, and you buy another index fund for gold. And I'm going to put 30% of my money in each one of them, and the remaining 10% of my money I'm just going to hold cash. So 10, so 30, 30, 30, 90 plus 100. And what I'm going to do is I'm going to rebalance annually. Now this is key to understand. This is what takes the 30 minutes. As we learned previously, no investment goes up forever. They all go in cycles. So stocks, for example, they go up, they go down. Bonds, the same. Gold as well. Any investment you take, real estate, they all go up and down. They all go in booms and busts and cycles. So what rebalancing annually means is that, let's say I started off by putting 30% of my money in stocks, 30% in bonds, 30% in gold, and then 10% cash. Let's say at the end of year one, I find that my money has grown, but these percentages are skewed. Let's say now my 3,000 has become, say, 3,500. However, out of this 3,500, 40% of it is in stocks. What that means is that stocks have gone up, and relative to gold and bonds, for example. Put another way, it means that stocks have been going up and the other investments have been going down. Now we know that that cannot happen forever. Everything goes in cycles. So what rebalancing annually means is that you sell some stocks until it becomes 30% of 3,500. Let's say if it's 3,500, you sell some stocks until they become 30% of your portfolio again, and you buy some of the other things until you get back 30%, 30%, 30%, 10%. That's what rebalancing annually means, and that's what takes you the 30 minutes a year. So let's go and see how this would have performed historically between about 85 to 16. Let's see how much data we can get. So I'm going to go to annual returns. And it's only giving me data from 2005, but it's a good start. So let's see. My total return for 2005 would be 9.66%, 12.21%, 14.23%, 0.77%, 8.59, 16, 13, 7. Now here I lost a little bit of money, 2.8%, not too much. 11.57%, lost a little bit of money, 3.36%, not too big, and then 6.49%. Now what is most interesting is this year, 2008. In 2008, stocks took a massive hit, as we know, because of the financial crisis. They went down 36.81%. However, bonds, the bond ETF, it gained 33%. The gold trust gained 4.92%. And therefore, even though the stock market crashed almost 40%, in this portfolio, you would have made 0.77%. How impressive is that? Now, this takes advantage of the fact that everything goes in cycles. If something is going down, like stocks, something else could potentially be going up. Of course, in theory, it is possible that everything goes up or down at the same time, but typically, this is what we would expect. If stocks are taking a massive hit, something else is quite likely going up. So if you spread your investments, your portfolio would be safe and you wouldn't be losing too much money, and you can invest by spending just half an hour a year. So as we can see, there are investment strategies that do not require us to read financial reports or keep up with the news or anything of that sort, and they only take about 30 minutes a year. However, the strategy that we just saw is a capital gain strategy. What that means is that it grows your wealth, but it does not generate any income or cash flow. So the next avatar that I frequently meet when I talk to my friends and others is that I want to create a monthly income from investments, but I still don't want to read financial statements and reports. And I understand that generating this monthly income can take a little bit more time than half an hour a year, so I can spend, say, 30 minutes a month to create this income. This can be done too. What we do is we take that same index fund that we talked about previously and we sell options on it. Using options, you could generate about 2% monthly income from your investments. So say, for example, if you wanted a monthly income of $200, you would need a portfolio of about $10,000 and you could generate about a 2% return on it, or a $200 monthly income from it. And the final avatar that I meet when I talk to friends is I love investing and I'm willing to read financial statements and reports of companies to get better returns and take advantage of unique opportunities in order to grow my portfolio and generate an income from it. So in this case, we would dive into how to analyze a financial company, a financial statement, how to analyze whether it's a safe company to invest in, how to maximize our chances of success. Of course, nobody gets it right all the time, but if you do get it right, the returns can be phenomenal. For example, as I shared earlier, this year, one of my stocks, it doubled in about 7 months. Now, if none of these appeal to you, then I would love to hear from you, because these are the 3 avatars that I've met most frequently. But if none of those appeal to you, if you have any special limitation or something like that, I would love to hear from you. I'm very passionate about talking to people about investing. So right at the bottom of this course, you would find the link to book a 10-minute call with me, or you can write to me via email, and you'll find those details at the end of this course. Let's look at some frequent investing myths. One myth that is out there is that the more time you spend, the better the returns. The reality, as I've found through my research, is that the most time-consuming strategy is actually the one where the fewest people succeed. If you're curious to know, that strategy is called scalping, and essentially what it means is that you sit down for an hour or 2 hours and you buy and sell, buy and sell, buy and sell, buy and sell many times, 15, 20 times perhaps, in those few hours in the hope of making a high return. However, research shows that only about 1% of people who do that actually succeed. The next myth is that strategy X is the best because of yada yada reason. The reality is that all investors, including legendary investors like Warren Buffett, they also have some years of not so good performance. And as we discussed earlier, it is consistency that's always the key. Lastly, the last myth I hear is that you have to analyze financial statements and invest in individual companies to get a decent return. The reality, as we saw previously in that article from MarketWatch, is that most investors, over the long term, do not beat the index.
Alright, so let's take a look at an example of what this would look like in reality. This is my Thinkorswim platform. It's a simulated trade, so I'm going to go check out, let's take SPY as an example. Its last done price was 229, right? And what I'm going to do is I'm just going to use Google, and let's say I'm starting out with $5,000. So I want 30%. for example, in SPY. So I'm going to say 30% of 5,000 is how much, and it tells me it's 1,500. So if I were to buy $1,500 worth of SPY, and SPY is at 229.34, then how many units should I be buying? So I'm going to say 1,500 divided by 229.34 gives me about 6.54. So I'm going to tilt to the higher side. I'm going to buy 7. So I'm going to go to the last done. I'm going to go to here, ask price, which says buy. And I'm going to say I want 7 of them. 229. I'm going to click confirm send. It's going to give me a confirmation. Buy plus 7 of SPY, so it's going to cost me about $1,615. All right, there's going to be a little bit give and take because each unit is 229. So we may not be able to invest exactly 1,500, but an approximate. And you click send, and when the market is open, it should go through. And then likewise, you do the same for the other one. So let's say TLT. For example, today bonds is at last done 119.25. So again, we can take 1,500 divided by 119.25. That gives you 12.57. So I'm going to go with 13 again. All right, so you go to ask, which is buy. Click 13 here. And then confirm send. Check it. It says 1560. Yep. And when you're ready, you click send. And that's how you set it all up. And then as we discussed in the previous lecture, right, when things go out of whack, like once a year, you rebalance it. So you calculate how much you have in each of these. So let's say bonds have really done well, and now maybe they've become half for your portfolio, like 50%. So you sell some and make sure that you're back at 30%. So that's essentially how it works. All right, so that brings us to the end of this course. All right, essentially what we have learned here is that how you invest and what you need to learn about investing will depend on 3 things. Number 1, time. How much time you want to spend on it and how much time you can spend on it realistically. And you don't have to, as we've seen, you don't have to, sit at the computer all day. You could set it, forget it, or you could just come back to it once a year. It's completely fine. And number 2, of course, is how long you intend to hold the investment. So if you're not comfortable holding an investment for a long period of time, obviously you'll use a different strategy compared to somebody like me, for example, who's a long-term investor. Secondly, it also depends on what your goal is. If you want to generate cash flow from it, then of course you'll be investing in a different way and in different things compared to if you're just saving up for retirement, 20, 30, 40 years from now. And last, but perhaps the most importantly, is what preferences and limitations you have. So if some of us may, for example, we don't like staring at charts, some of us may not like financial statements, some of us don't like numbers. Each one of us is different, we have different preferences. But as we have seen, we can overcome them and invest in a way that suits us and we will enjoy. So one last thing I will leave you with is that the cost of indecision is very high because every $100 that you don't invest today, assuming a 10% annual return, you miss out on $672 20 years from now. So what is most important to make a decision and start, and to help you out, I've attached a cheat sheet or a questionnaire that will help you go through this and kind of help you determine exactly how you would like to approach investing. And remember, if you have any questions, please go ahead and post it in the Q&A column. I look forward to helping you out. Thank you very much for taking this course, and I wish you all the best, and I hope I have the opportunity to serve you further. Thank you.